the same thing can happen elsewhere. You know, we've just been through Brexit ourselves, and who knows what the consequences might be, good or bad, and I'm not going down that rabbit hole. But, you know, you can't, these things are unforeseen and unpredictable. And I think it'd be naive to think that one geography is definitely going to do good in the long term, because weird things do and will happen in the future.
Yeah, no, definitely agree. No, I think that's a really good...
The Russian military has begun a brutal assault on the people of Ukraine. Without provocation, without justification, without necessity, this is a premeditated attack.
Even when making those comments 3 months ago, I could have never foreseen a war erupting in Europe. But then again, I never foresaw a pandemic either. For me, being an investor with or without Vanguard right now reminds me very much of a song from one of my favourite annual TV programmes back in the day. 2014 Wipe was 2014's instalment of an annual series reviewing the year. The creator of the show, Charlie Brooker, performed a song titled Reasons to be Fearful 14 as a response to the consistent negative headlines throughout the year that went a little bit like this.
Reasons to be fearful 14. Constant global crisis, Syria to ISIS, rising living prices, we can't cope. Rolling news is leering and looking on and cheering, and Danny Dar's appearing in our leading soap.
You get the gist. Well, I think you could easily do a 2020s version for investing. You got Brexit, high inflation, COVID, and now Russia. How much fear, uncertainty, and doubt can one stock market take? Based on this, I want to cover what I believe this fear, uncertainty, and doubt tells us about the stock market right now, and why it might mean that your Vanguard account might be a loaded spring waiting to snap back. But then also, what the invasion of Ukraine might mean for investments over the next few years, while finally looking at why the traditional stock market graph is pretty misleading. After all this, I'm sure everyone is interested to know how much I've lost over the last month. Nothing like some gruesome portfolio porn, hey? Let's get into it. So last month, I spoke about the stock market being a measure of expectations for the future, visualising this by eating dog food. Okay, it was corned beef, but it did the job. If you think about it, over the last 3 months, we've had threats of more COVID lockdowns due to new variants, governments changing their interest rate guidance due to surprising levels of inflation, and now we have the highest threat of nuclear war since the 1980s, which let's all appreciate that the majority of my audience, including myself, will have never faced before. Just like how none of us has faced a pandemic before, well, unless you're over the age of 100 and you're familiar with the Spanish flu. Shout out to you, Ethel. You are a babe. So what has this done to the stock market? If you look at any broad global ETF, you'll see that we're only down 8% year to date. So Putin's threatening to drop a nuke on the rest of the world, and we're sat on an explosive level of debt with interest rates going through the roof, and we've only dropped 8%. It's nearly laughable. So we must really ask ourselves, why hasn't it dropped further? Well, there's only two possible reasons why this might be happening. The first being that the news at the moment isn't as bad as it might seem, or secondly, it could be that there might be an underlying reason propping up share prices. I think we can all broadly agree that option one of the news not being that bad just doesn't make sense. We know the stock market doesn't like uncertainty and reacts heavily to fear, so it can't be that. So it has to be option number two. Something has to be propping it up. But what could that be? In my mind, it has to be inflation. We're now facing a double whammy of inflationary factors. At the moment, we're feeling the after effect of the quantitative easing in reaction to the pandemic. Quantitative easing just being a fancy word of we've created a load of money. And high inflation isn't anything great. If you think about it, if we're down 8% year to date and inflation's running at 7%, we're effectively 15% worse off. Yes, on the surface, we're doing pretty well at just being 8% down, but our relative value in our accounts is lower than it's actually showing. But this isn't the only inflationary linked issue in our field of view at the moment. Due to the conflicts in the Ukraine, we are likely going to see further inflationary factors dumped on top of our existing ones. People will argue there's between 4 to 8 different types of inflation, but ain't nobody got time for an economics lecture right now, so let me cut to the chase. The inflation we're about to face is referred to as cost push inflation, meaning that an increase in a widely used commodity is going to create a chain reaction up the supply chain, making everything more expensive. In this case, it's good old oil. Even though we're heading into a brand new world of renewable energy, our planet is still wholly addicted to oil. So if oil goes up in price, it affects everybody. But why does it affect everybody? Well, it's fairly straightforward. There are not many things in our lives that don't have part of its price factored on the price of oil. Without going into hundreds of examples, just think that anything that's being transported to you, food, products, services, are likely used to get to you by oil. And on top of that, just remember that oil is currently the largest fuel relied upon to create electricity. There's no saying how much cost plus inflation this is going to cause or how sustained it might be, but any increase, say 3%, is what we need to see reflected in our salaries and portfolios to make sure we're not going backwards. As it stands right now, Brent Crude Oil, which is one of the main indexes for oil, has hit a price of $113 per barrel, or £85 in good old sterling. This price is double what it was just 1 year ago, and we haven't seen prices this high since 2014, when there was low levels of production of oil and a raging war in Libya in Africa, which has the largest oil reserves on that continent. So what am I doing about it? Well, the expectations of high inflation is scary, as it means the cost of the businesses that I own are increasing, which means it eats into their corporate profits, which is the main driver of their valuations, but it also goes into funding their dividend payments and share buyback schemes, all negatively impacting me as an investor. But what other choice do I really have? We all know that the best hedge versus inflation is to hold assets such as stocks, gold, or potentially commodities. Based on this, it'd be an odd choice to sell our stocks into cash right now, as cash is the very thing you do not want to hold in a high inflationary environment. So for me, I don't think there is any good reason why I'm going to change course right now, but I would love to know your thoughts, especially if you think about this differently. Before I share how my Vanguard portfolio has been affected, I just want to quickly highlight 2 reasons why graphs like these are extremely misleading. A massive factor keeping new investors out of the stock markets is a thought process of, now isn't a great time to invest in the markets, as the markets have grown so much over the last few years. They tend to claim that they have just missed the explosive growth over the previous numbers of years, so now would be starting at a bad time. Well, in my mind, the biggest contributor to this mindset is a flawed modern day market graph. Let's take a look. The first illusion is the bias of compound growth. By saying this, I mean that growth in the near term always looks larger than growth long ago. Let's look at the S&P 500 for example. If you looked at it right now, you would rightly point out that the S&P 500 has doubled over the last 5 years, and you might logically question how sustainable this can be long term. Over 2,000 points in just 5 years. Surely you should just wait, right? Well, by the S&P 500 standards, 5 years is far off any sort of record for it doubling in value. It only took 4 years between February 2009 and March 2013 when it gained 750 points. Then back in the late 90s, it only took 3 years between April 1997 and July 2000 when the S&P 500 gained 740 points. But if you think about it, in 30 years' time, our stock performance is very likely going to look just like how the 90s looks to us right now. It's going to look a little bit lifeless, a little bit like nothing has happened. But why? Well, consider this. Based on a growth rate of 10% each year, we would expect the stock market to double every 7 years, meaning that in the year 2057, the S&P would be around 150,000 points, compared to today's tiny 4,300. At this point in the future, the market would only need to drop by 3% to lose over 4,500 points. The second illusion is something I commented on earlier in this video, and it's the fact that your traditional stock market graph includes inflation. A higher return is only beneficial if it outstrips inflation. If your portfolio doubles in value, but the currency you hold halves in value, then you are no better off. Obviously, your currency losing that much value is unlikely to happen unless you live in Turkey at the moment. But the only return you are truly interested in is your real return, being your portfolio growth less inflation. Anyway, that's enough of what's going on in the world. What about my Vanguard portfolio? Well, if this is your first Vanguard portfolio update, then this is all you need to know. I only invest in the FTSE ALL-WORLD UCITS ETF. I've been investing since the start of 2018, and my strategy of investing is lump sum investing. No buying the dip, no dollar cost averaging. So in terms of last month, I held around 104 shares of VWRL, priced at £86 a share, following a little bit of a sell-off in January. This gave my portfolio value of around £70,000, which was a bit of a fall from my peak at the start of the year of £72,500. But as discussed previously, the world economy has been rocked by the horrific scenes in the Ukraine. A mix of the potential for an escalation towards nuclear war, the potential lack of supply of oil and gas from Russia, and then disruption to some of the key natural resources in the Ukraine, which are vital to the semiconductor industry, have got investors feeling very uneasy and has brought valuations around the world down. As a result, VWRL, the FTSE ALL-WORLD UCITS ETF, has come down 4% since last month, bringing us below £84 a share, which is the first time it's been below this mark since June last year. As a result of this small sell-off, My portfolio now stands at £68,250, which is the lowest it's been since October last year. And then equally, my profits are down to £12,500, which is the lowest it's been since May 2021. So what am I looking to do? For me, I'm shocked at how little the market has shifted, and I truly think there's a lot of money sloshing around the stock markets and being parked on the sidelines. And for me, I feel like this money is going to be forced to participate in the markets as high inflation continues, meaning that stock prices are probably going to go up. My direct debit went out on the 25th of last month, and it'll be continuing to go out on the 25th of this month. But luckily for me, I should be getting a bonus this month, which I will be also putting into the stock market straight away. I honestly believe there's always going to be a reason to be fearful, but capitalism always seems to find a way. The last few months, the cost of living has been increasing extremely quickly for everybody living in the UK and Europe. So if your salary hasn't caught up yet and you're looking for a bit of a side hustle to earn some good money for flexible small amounts of time, then I'd seriously consider watching this guide on Roamler, which I personally use. That's all for this video. See you in the next one.